Monday's bloodbath on Dalal Street left investors poorer by nearly 6 trillion rupees as a spike in oil prices shook investor confidence. An unexpected call by US President Joe Biden to ban oil imports from Russia, coupled with delays in the potential return of Iranian crude to global markets, fueled tight supply fears. Crude oil prices touched their highest since 2008, while rupee touched historic low of 77 per dollar mark as war in Ukraine threatened to inflate India's oil import bill and fan inflationary pressures. Equities too came down crashing with the benchmark S&P BSE Sensex and Nifty 50 sinking 2.7% and 2.3% respectively yesterday. They hit their lowest levels in 8 months. The two indices have corrected 15% from their lifetime highs of 62,245 and 18,604 claimed in October last year. According to analysts, India faces meaningful risks in terms of higher inflation, lower corporate earnings, trade shock, and current account deficit implications. This is because India imports nearly 3/4 of its oil, making it one of the most vulnerable in Asia to higher prices. Estimates suggest the Indian economy could incur an additional $70 billion burden or 1.9% of GDP at an average crude price of $120 per barrel. Analysts at Bank of America believe if most of Russia's oil exports are cut off, there could be 5 million barrel or larger shortfall globally. That means oil prices could double from $100 a barrel to $200 a barrel. JP Morgan analysts meanwhile expect oil to soar to $185 per barrel this year. A marginally conservative estimate by Rahul Kalantari, who is Vice President for Commodities at Mehta Equities, suggests that WTI prices could test $140 per barrel and Brent prices could reach $134 a barrel going ahead. Technically, crude oil has support at $118 to $110.4 per barrel and resistance at $129 and $140. Given these headwinds, we have Alphaniti FinTech co-founder UR Bhatt with us to understand the road ahead for the markets.
FIIs have been sellers for quite some time now, but the DIIs and the retail partners have been more than compensating by FIIs. But if you see over the last few days, FIIs selling has intensified quite dramatically. I mean, it was about $200-300 million per day, but now it is nearing $1 billion a day. So I'm not very sure that the domestic institutions and retail can really compensate this for too long. They don't have that sort of muscle to keep buying when FIIs are selling in such a big way. So therefore, I think that equilibrium will probably get reset at lower levels. So you really have no sort of good news coming from anywhere. All the bad news is just sort of getting bunched up and coming. And we don't know how this talk of terms of nuclear misadventure and all that. So therefore, I think market will continue to be very, very drift by fear. And so therefore, I don't see, given the state of news that we are seeing, that there will be some respite immediately, or that whatever the fears are there at these levels are unformed.
Meanwhile, tech charts too suggest more downside for the markets.
This is the first time both the indices, Sensex and Nifty, have broken 50 weekly moving average. Last time when it did so, it was in mid-2021. Both the indices have broken sentimental support levels of 54,000 for BSE Sensex and 16,000 for Nifty 50. Here on, for Sensex, as long as it trades below 54,000, there are higher chances it can slip to 50,000 levels. The immediate resistance, higher side selling pressure resistance, comes at 56,000 levels. For Nifty 50, it is 16,200 and 16,500 are the major drop-down mark. In the sense, this level when violated, it could have shown a decisive reversal, but it failed to do so, and there are higher possibilities it is heading towards 15,000 levels. On the upper side, as long as 16,800 is not taken out, this index is here to stay in a weakish scenario for some more time.
On Tuesday, the markets will continue to monitor global developments besides taking guard for the outcome of assembly poll results across 5 states: Uttar Pradesh, Punjab, Manipur, Goa, and Uttarakhand.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.